Thomas Haug, founding member and CEO of Aspen Tree Advisory. Aspen Tree Advisory is a multifamily office for 3 families based in New York City. I'm also a partner in a group called IDI Group. IDI Group is a venture capital cooperative that invests through a fundless sponsor model. There are 6 founding members, 2 additional members that are part of IDI Group. I sit on the board of a cannabis company called Pure Cali. And I am on the advisory committee of the largest floor trading business on the floor of the New York Stock Exchange called Ameritage Executions.
My name is Steve Powell. Oh, it's on. Okay, so my name is Steve Powell. I actually just run a personal family trust. So my wife and I have actually just set up a living revocable trust for ourselves. So that's our structure. Myself, I am actually a retired high-tech exec. I have been the early employee and executive of 7 startup companies, 2 of which went public. So I was a VP of Marketing and Product Management for a company called Latitude Communications that went public on the NASDAQ back in 1999. I was the SVP and GM of the security business for a company called Barracuda Networks that went public on the New York Stock Exchange back in 2013. Most recently, I spent the bulk of my adult life in Silicon Valley, but I'm a native of Seattle. I currently live in Portland, Oregon. And since my wife and I became empty nesters, what's really happened is I've retired from full-time work. I currently advise early stage companies in the technology space, and on my own, I'm a Keiretsu member, basically participating in direct investments in companies that I would not have otherwise have access to within my own deal flow.
Hi, I'm Armando Viteri, and like Stephen here, I'm a serial tech entrepreneur. And like Stephen here, two of the companies I was involved in went public, awesome. Some of the other ones didn't do so good, but on balance, it was okay. So that's the life in tech. So I'm a partner in Ameritage Technologies, which is a boutique private equity firm that mostly historically is focused on tech turnaround situations, VC zombie companies. However, that's evolved into a syndicate, essentially a loosely held pledge fund, where we wind up looking at about 30 tech companies a month, and we wind up choosing one every 6 weeks or so that we work with. And when we work with them, we'll work with them from pre-seed all the way through a Series A. So typically a 3-4 year engagement, multi-rounds. So we really get to know these companies pretty in-depth over long periods of time. Oh, and I'm also the chair of the AI Special Interest Group out of Silicon Valley chapter. Anybody interested in AI, come see me.
Thanks for having me today. I'm Lisa Rich with Hemisphere Ventures. I'm also a tech entrepreneur. My husband and I built a company called brainyquote.com, which is a 20-year-old website. It's #1 on the quotations, #1 quotation resource in the world. It's reached 8 billion people, and we have a team of 5. We know how to build companies that can have a large footprint, and we love revolutionary technologies. In 2014, we decided to start building out our own family office with our goal of diversifying our portfolio. We know there was a lot out there beyond stocks, bonds, and equities, and we started looking at angel investing. Pretty soon we were looking at 1,000 deals a year and investing in about 80 companies, and to date have made over 200 investments, direct and passive. So part of those are syndicates, part of those are direct. And as a result of these activities, we created Hemisphere Ventures as a firm to syndicate deals and accelerate our investments, which emerged, I should say, we invested across all of these sectors of the 200 deals we did. And as we made those investments, we realized that our thesis really was emerging technologies, specifically frontier tech. For us, that was the new internet. We were babies of the internet, or had launched our businesses at the start of the internet, and we said, what is the new groundbreaking stuff that we want to invest in? And for us, it's in the areas of synthetic biology, robotics, drones, and space, where we can see incredible growth, incredible trajectories of businesses that have real legs. We like the idea of massive scale and profitability as we achieved with the internet, so that's why we're investing in those areas, and I can't wait to share more about them.
Thank you, Nathan, Brianna, Juan, Maggie, and team. This has been a great event, and thank you for putting it together. So I work for Onlan Capital Ventures, and we're a family office founded company based in Hong Kong. It's essentially the venture arm of the family office that invests both on behalf of the family and affiliated families often. Since our founding, we've diversified into a few other segments, including APAC expansion services. Sometimes it's in conjunction with portfolio companies, and other times it's independent. And we're also majority owners in a tech services company. Personally, I'm the boots on the ground in the U.S. and formerly a only lawyer. Now I'm a lawyer and also a not lawyer. It's been a great opportunity to dip our toes into the venture world, and there's several driving forces behind our philosophy on venture. We're definitely subscribers to the Yale endowment theory, and we believe that alternative investments, particularly venture, particularly early stage, offer really outsized returns if picked wisely, given the wide standard deviation. A lot of motivation also comes from a desire to know and understand a really exciting space, touch and feel new technologies that are emerging around the world, and last, there's a lot of demand to be involved to the extent it makes sense in building certain of these companies. These families are families who have been builders in their own right, and that's a major attractive feature to look for potential investments.
So my name is Crysti Chen. I am the co-founder and the general partner of UniWill Ventures. So UniWill Ventures is a relatively new venture capital fund. We are a part of a multi-family offices, and we also established this multi-family offices by ourselves. We are second generations from the this family offices. The multi-family office has 3 families together, and both me and my business partner, Winston Sen, we are in charge of this venture capital fund. We're the second generation of those 3 families. And we are both Chinese, came here, studied, and lived in the United States for 10 years. And for now, as all our families have gone public in China mainland, we decided to put asset, to have a diversification in asset allocation in the United States, especially in venture capital in early stages, investing in early stage companies. So for the past 3 years that we've been working in this, we had direct invested into 30 companies with 3 exits. On average, the return on investment exits for 400%. And we do some cross-border early stage investing. So for us, we are the millennial generation, as a previous speaker talked about. I care about philanthropy, have done that for the past 10 years. And I'm trying to emerge my philanthropic vision into this venture capital fund. So we're trying to develop a social impact fund. Although it's really hard to measure the impact, and also I care a lot about the return on investment to prove my own success. But I'm trying to merge this together, and because there are a lot of sensitivity in technology across borders nowadays in between US and China, but I still believe among social enterprises that we can the vision that they are technologies for good, for general good, for to benefit or to enhance accessibilities in education or in different resources. So I'm trying to do that for the next few years.
Great, thank you all. I actually haven't had a chance to meet any of the panelists yet, so appreciate all the introductions. We'd like to try to keep it somewhat interactive. Throw out some questions, and I'll try to make sure everybody sort of gets equal time, but happy to get everyone's input on everything. So I thought it'd be good to cover some of the basic things, but also some of the questions that I've been hearing from a lot of family offices as it relates to sort of generate venture investing in general. So Crysti, I'll start off with you. From my point of view as a fellow millennial, maybe I could sort of say that families have really taken notice of venture with recent unicorns and the fact that it is sort of a new economy out there. And yet there's the caution out there, specifically the topic this panel is technology and medtech, medical, healthcare investing, which has been an amazing place to be for the next 10 years. Typically in any field of investing, if it's been a great place to be for 10 years, it's not a good place to be for the next 10 years. I don't agree with that. Do you? And what are your thoughts going forward? Is technology and medical technology still the place to be?
I think technology has been disrupting the way that we live for the past 10 years. Technology, for me, is not necessarily the website where the www, like just not that anymore. So I think technology is still evolving, but for life science, I don't have much to say about this, but my family business is a life science business. So they are one of the most innovative and has most of the immunization pilots in China, and it's a public company. So my only involvement in life science project was that we acquired, when I was still in university, I did this with my family, that we acquired a company from Harvard, biomedical research development company, and we're putting this company to public in Hong Kong Stock Exchange next year in January. So that's my only, and also I studied political economy and like social work MBA, so nothing related to life science, but I do know that from Gates Foundation past Chen's initiatives, they are doing a tremendous work in the gene science, in the life preventative disease studies that is so important for our future generations.
I'll be concurring to that because I think we have a perfect storm about to happen in technology. You have some perfect confluence right now between nanotechnology, CRISPR, and computational techniques, including AI. You have a perfect storm of those technologies all suddenly becoming mature, and those will all integrate, and they're going to integrate into life sciences, and there's going to be a fundamental shift that's going to look more like a step function over the next 10 years. So I actually think this is a really exciting time for life sciences investing. I think it is an exciting time for technology investing in general. Again, because I think what's happening is that there's been a number of nascent technologies that have been percolating along for the last 20 or 30 years. They're suddenly coming into their own, and all of that's really recent, really coming into their own less than 5 years.
Adam, one of the comments you made this morning was that AI in general has been sort of overused, but when AI is put in front of anything nowadays, it's become really popular, and a whole lot of venture funds are calling themselves AI funds, and companies doing just about anything sometimes are somehow throwing in artificial intelligence. Is the term being overused here? Does it really mean anything going forward?
Yeah, that's one of the pre-questions was what are some red flags, and I think for us the rampant overuse of buzzwords like AI is something that we or blockchain or big data, and, all of which I agree that it seems to me we're on a vanguard of critical mass for these technologies, including AI, to be very impactful. But sifting the bold claims from the the walk from the talk, I think, is more challenging. And that's where I think proper diligence and proper access to the right kinds of experts and the ability to track a company over a period of time before investing is can be very beneficial.
Lisa, you're in a lot of companies. There's always sort of macro concerns out there about the world. A recession is going to come at some point. I don't think it's anytime imminent, but considerably in the next couple of years. How much of a concern, with a full portfolio of venture that ultimately needs capital and more capital, and liquidity could dry up, how much of a concern is that? Can you protect yourselves, or is it just a question of riding out the storm?
I don't see there being a stop to the interest in venture with the types of companies we're looking at. What I do see is the concern that I have, I'm sure many people in this room share, of watching the news and seeing the Fortune, another company out of the Fortune 100 is dropped out of the Dow, kicked off the Dow. This is what's happening more and more, and so that's why we're looking at economies of the future. We're looking at companies that are creating new vertical marketplaces that don't even exist today. So companies like cellular agriculture, where they're growing pork from stem cells, they're making fish from stem cells, they're making amino acids without the chicken. These are companies that are creating the future of food. These are technologies that, to the point of the convergence of all these AI plus machine learning plus hardware equals accelerating capabilities. So when we talk to our investors about the opportunity, there are always dollars behind it. So we're looking at companies where they're early stage, they're seed stage company with a capability, for example, in space, where they said we have this ability to image at 1/4 meter resolution, image the Earth. Well, why is that exciting? You can see a power station is turned on or off. You can see the speed of oil moving through a pipeline. You can see the thickness of a leaf on the trees. You can determine weather. These are really powerful pieces of data. Well, this company, within 30 days, we said, prove it. Is there demand for this? In 30 days, they had $100 million in orders for their imagery. We're a year out now, they have over $2 billion in back orders. The company was at 10 million valuation, then 50, now 200 million within 2 years. That's serious traction. And our investors are interested in that. So that's why they're enthusiastic.
Armando, going sort of in furtherance of a point you made quickly before, some friends know 35 years ago I started off in astrophysics and found it was a lousy way to meet girls, so I went into finance instead. But more will be discovered of the universe in the next 5 years, the entire history of mankind put together, without question, possibly in the next 3 years. Not so much difference in healthcare and biotech and all of that. There's more get learned and accomplished in the next few years than in the entire past of all mankind.
No question about that, right? I mean, sequencing the human genome alone, I mean, we're just at the starting stages of what the implication of that one event will have for humanity. And that's just picking one area. So yeah, by all means, we'll learn more about the universe, which is certainly intellectually interesting, but we'll learn more about the nano in this next generation, which will be much more economically interesting, because there's so much application for it.
Steve, from a family office perspective, for a typical family office, what % of assets, or what amount should be put into venture, and how does one, and as you know, most family offices are really just not in venture at all. A few have a great interest in it, they've been talking about it for years. How do you first start that move into venture?
Yeah, well, I think for me personally, it was always about having some kind of bet on the table. So as an entrepreneur and early company executive, obviously the bet that you put on the table is with your own company. And obviously that represents a pretty significant percentage of what your net worth or your potential net worth is going to be. I think that moving more to a portfolio strategy, from my perspective, most of those around me have indicated a preference for something on the order of 15% or less of the portfolio, be in these kinds of alternative investments. I think that leaning toward the high end, I think that one of the things that becomes important as you look at the overall portfolio is within the bet of these alternative investments and within venture investing is to actually look at the kinds of opportunities, because I certainly agree with the comments that were made around artificial intelligence, whether they be around machine learning or computer vision or natural language processing. There are a lot of areas to go look into, and there are big macro trends there. Beyond genomics, where we're discovering there's now this whole proteomics field, which is the next layer down. So there's certainly big macro level trends. But I also think that what's really interesting about where we're at, for example, within healthcare, is that a lot of things that were actually pretty well established in other industries were pretty slow to get to healthcare. So for example, I'm invested in a company that's actually doing air-coupled ultrasound to be able to detect ear infections. And it turns out ultrasound technology, and my master's thesis 30 years ago was in multispectral imaging. And it turns out that the fact that this kind of technology is finally being applied to detect children's ear infections is really cool. I think that being able to provide applications of killing bacteria with visible light. I just invested in a company called Lightline Medical that is finally actually using this for catheters. So it turns out there are a lot of, I think, pretty de-risked investments from a macro level trend perspective that you can get in. So as I look at the overall kind of venture part of the portfolio, it is not just about what percentage of the overall portfolio is going into venture investments, but also what are the venture investments going to look like in the breakdown in terms of what I expect the kind of the risk reward and that kind of breakdown to be. And so I try to balance kind of the long play macro level trends with things that just tactically make a lot of sense, where some entrepreneurs have come up with something and there are good returns in there of pretty de-risked investments.
Thomas, let me hit you with the hard question then. A family office coming into this talked about how to structure this. For a family office entering it without using a commingled fund, in other words, finding a bunch of direct companies, how do they properly diversify without over-diversifying? That is, getting a good portfolio. Is there a number out there that they should be using, given the fact that no matter how good they are, you're going to lose a few of these companies along the way? Can one just be in tech and med tech and things of that sort and do well, or do you need to diversify outside of that? And is there a minimum number of companies they need to build a portfolio?
So I feel in certain strategies specific to venture capital and angel investing, a lot of people look at it as a numbers game, and for the most part, I do think it is a numbers game and a hit rate game. That said, I come from the hedge fund, private equity, real estate, co-investing world, where we would invest either as an LP or co-GP in those vehicles. And I solve for a specific percentage of my client portfolios, probably less than 25% of their asset allocation. That said, that was kind of the impetus to founding IDI Group. IDI Group is a group of members that either have only invested in venture and angel investing, or had a desire to but didn't have a resource to help with diligence or specific sectors such as life sciences or technology. So if you look at our group, it's a pretty diverse group, and each member of the group adds some sort of value for the vetting and lead investing in that deal. So if you think of some of the deals that we've invested in, for example, one is a SaaS-based women's underwear company founded by Sofia Vergara, and we're the lead investor, and we have other participants that could come in through the fund with sponsor model. Another one's an augmented reality technology company. Another one's a coffee maker, bean to cup, and it brews through a centrifugal force with no waste. Another one is Bellhop, which is a rideshare aggregator, aggregates Uber and Lyft, along with black cars, taxis, so on and so forth. So when you think of our portfolio, it's relatively diverse, which hopefully mitigates some of the risk in that portfolio. The reason this conference was very important for me to attend is we don't have a lot of med tech, life science companies in our portfolio, We have 2 that are invested by certain members in the group, but not all members in the group. And basically through IBI, if an IBI member brings a deal to the table, the investment committee approves it, we all invest in it. We make a certain capital commitment, we will syndicate portions out for friends and family to invest alongside us at the same terms we invested in. That said, if we don't get those friends and family to invest, we still need our capital commitment. So I think we have to be very thoughtful about the companies that we invest in and the commitment level that we make. But to more directly answer your question, yes, I do think it's a numbers game, but it's a numbers game within the capital that you have to work with. And if you have a lack of capital and a desire to invest higher dollar amounts, I think a stronger focus on diligence has to take place. And it is very important that any of the C-level executives in this company or the founding members of the company have skin in the game.
Thank you. Crysti, you've been taking a lot of notes, so I think I should call on you. Talk about co-investment. What type of investments do you like to syndicate or co-invest with other, whether it's families or investors, angels?
So most of our investment are co-investments. We haven't been the lead investor for the venture capital ourselves because I know this the best. But for a lot of industries that I've been looking at, for example, as they've mentioned, agriculture technology, vertical indoor farming, gene sequencing, the alternative food industry, also the waste management, the totally reusable, composable materials, and those ones are our focus, and also it fits our investment thesis. But we don't have adequate knowledge. So in all those, we would be the follow-on investors and co-invest with families or even strategic partners who has more industrial knowledge.
Adam, on the topic then of co-investing, how do you find the co-investors? Is co-investing that important to work with others in the whole process?
Yeah, well, I mean, it's the context can vary, but some common motivations, definitely building network trust and collaboration. We're more, we view ourselves as more, able to get better terms, able to get access to better opportunities, to the extent that we can, offer a larger check size. So sometimes that's a motivator. Other times, we like to be value-add investors. So finding the right, co-investment group with others who are influential or impactful in the area. And we made an investment in a CRISPR company about a year ago, and we specifically sought out co-investors throughout China and other regions in Asia that we thought had either they themselves were strategics or had good access. So I think enhancing the value of our ability to be helpful to investors is important. Harnessing more leverage to get better terms, and solidifying relationships with partners across our network. Those are all common motivations.
Lisa, how has the early stage technology investing landscape changed over the last few years, and what do those changes mean for family offices? The world of venture investing changes every year or every day or things of that sort. What have you seen on the positive side?
Well, I would say, I'm a bootstrapper, and so we didn't turn to services to create our family office. We figured it out on our own. And now we're meeting family offices that are saying, how did you do this? Well, we had an ace up our sleeve because my husband's an information architect, so he was able to develop a database that I have on my phone where I can pull up any of our 200 investments and tell you all about it. But we really were on the ground people building a network since 2014 where we were going to different accelerators, building relationships specifically with the Sean O'Sullivan's accelerators, IndieBio, FoodX. He's got 9 accelerators around the world. They're all very vetted teams. So we were getting pre-vetted companies, if you will, and then separately building a network of experts so that we could turn to help vet the deals. So trust has been mentioned in this forum today, and I think for us, while we had participated in deals, getting deal flow from maybe the different angel networks to invest previously, we started to say, you know, we want those personal relationships ourselves with the founders. We want to make sure that we like the founders. And so it's a lot of work, and we've been on the ground building these relationships. So now family offices are coming to us saying, who are you working with? Because you've got some amazing companies. Well, it took years. And what's great is we built a network of really smart people who know really smart people who are starting companies. And we meet these companies at the earliest possible stage, and it can be years before that first investment, but when we have that first opportunity, we're the ones they call. So we have that access. So I think for families starting that really want to get their hands dirty, it depends on if they want to get their hands dirty, and we did. I mean, I want to be in a lab. I want to see what the scientists are doing. I want them to tell me what they're doing until my eyes glaze over and I don't even understand it anymore, because I want to know as much as possible before I invest, and I know most families do too. So we're very hands-on, and for the families that aren't as hands-on, they've organically become attracted to Hemisphere and are joining our mission. So we've attracted about 700 LPs, and now we have a fund, and we're absolutely humbled by the people that are coming to invest with us. They're $100 billion assets under management. We have people like that talking to us. So I think we've made good choices now, but you have to have a lot of skin in the game, and you have to have a lot of deals across a lot of sectors to cover your bases. So we've already done that, I guess, and so now that we're focusing on frontier tech, our suggestion for families is that why not invest a tiny sliver of your income in this type of emerging marketplace, because it could really pay off long term. Helpful.
Nathan?
So just a real quick update, we got about 25 minutes left. We are going to collect the gold sheet, so appreciate everybody to pull this out of your booklet materials there. If you could put down your name, phone number, email address, and you don't have to fill it all out, but please do check through all the companies. If there's ones you want to follow up that you have interest in, had a connection with, and you'd like to, please do fill out your information. It also has a spot on the front here. If you have any topics you'd like to see at our next Crysti Family Office event in March, please let us know. If you'd like to participate as a speaker, and any other comments, feedback. Feedback for us is the Breakfast of Champions, so please do put that down and let us know how we can improve for next time. And please do indicate your interest. We'll collect all these from everybody as we head out after the event in about 25 minutes. Thanks, everybody. Howard?
Thanks. Armando, talk about the benefits of syndication of portfolio companies.
I think that was, Adam kind of addressed that, I thought, exactly right. The reason why you want to syndicate, by all means.
Disagree completely, but go ahead. It's no fun, okay.
All right, I'll disagree completely. There is value in syndication for the sake of having a larger pool of cash available. However, first and foremost, the value is bringing in other domain expertise, other networks, and that's what it's all about. For example, we do life sciences investments. I'm a software tech guy. What do I know from life sciences, right? So what we run across interesting life sciences companies, we reach out to people that have built their careers and their family offices around life sciences, and their expertise and their ability to diligence and their ability to make all the right connections, et cetera, is invaluable for making that company successful.
So in furtherance of that, the second part of that question was, everyone has talked a little bit about the importance of co-investment and syndication. How do you find the proper co-investors?
It's been just a question of personal network, right? It's people I know that I've typically known for a long time that I trust. Some cases reaching out to specialty angel groups that may have a super, like life sciences angels in the Bay Area, as an example, reaching out to groups that have domain expertise.
Thank you. So Steve, how do you build that network?
Well, I think that there's the how to build a network, and then I think there's also something I like to add to complementary objectives. I think one of the values of syndication is when you can get a good complementary set of investment objectives. So for example, it's nice to pair up folks who like to participate in early stage with folks who like to participate in later stage. Because then that way, when a company is on the bubble, you actually have the opportunity to be in a situation where really good companies just don't run out of cash. And so I think that it's important to pick folks that not only can provide subject matter expertise from a complementary perspective, but also it's nice to have some different investment objectives. I think in terms of the ability to find partners, I think that one of the things that's really good for that is actually just participating in deals, because the interesting thing is that there's a natural networking opportunity that actually comes by the fact that as I've personally found that as you jump into different deals and actually you start to work with other people and you start to get advice provide advice and get advice and provide different viewpoints. It's actually a great way to do it. And so I think it's a matter, I think participating in deals is just a good way to expand the network.
Steve, Lisa talked about using some accelerators as a good source of companies, and we've done that within our family office as well as have some others. Every major university now has an accelerator program. Some are just incredibly awesome. Do you make use of those? How valuable are those?
Yeah, I think that those are actually really good. I think that the funny thing is that down in Silicon Valley, like Plug and Play is actually one of the biggest participants, because almost one of the first things that a startup needs to do is get space. And so it was a really great way from an accelerator perspective. I knew that when I was at American Networks, we actually tried to go do, or we actually did about just over a dozen acquisitions, while I was there, and literally going to those incubators and looking for good opportunities. You actually find that to some degree you can find folks that have actually been screened by another set of folks, and to another degree you can actually just find folks who you can just use them to get deal flow. So I think they're a very, very good source. I think the big trick with some of the incubators is to actually look at some of the ways that they manage through their participation rights and manage through some of the other terms that they actually build into their initial investments. And so you just have to be a little bit careful working with companies that have actually been vetted through some pretty sophisticated incubators, because they might have some hairy terms written into their initial financing.
Thomas, I asked this question before, but we'd like your view on it. How is early stage technology investing, tech investing, the whole range, has changed a bit over the last few years in many ways, and certainly become more aggressive and a lot more people are interested in. Talk about what those changes mean, and going forward, what additional changes would you like to see?
So I would say a few years ago it was more a sponsor and investor type model, more in a fund structure, or you had your players in Silicon Valley, so on and so forth, that took the lead on most of those deals. And if you wanted to get involved in those deals, you were a passive or later stage investor. That was kind of the driving force to IDI. And I think today a lot of it is family office, club type situation. And to go back to an earlier question that you asked about your partners and how do you select those partners and how do you navigate a network to find those partners, I think when you're operating on a co-GP level or a co-investor level in a company that you don't have a very near-term exit and you're not a passive investor, you need to know that the people you're co-investing with are like-minded individuals, at least in their investment thesis. So if you look at our group, one Dutch gentleman has one of the largest shipping companies in the world, right? I know nothing about shipping, I know nothing about the logistics on his business. Another individual who's very public about it is John Najarian. He sold his Options Monster business to Citadel for about $750 million. And I know nothing about options trading, right? Another person has been an alternative investment attorney for, almost 3 decades. So you look at that and you say, all right, and then I've been an advisor, much more on the plain vanilla investing side of the business. Most of my career investing as an LP on behalf of my clients in hedge funds, private equity funds. So I think diversifying your group, knowing who you have a long-term appetite to invest with, and knowing that you all have the same thought process of how to exit a transaction. I was speaking to someone here earlier, and they said, well, our plan is in 2 years to get taken out. And I said, well, what happens if you don't get taken out? Are you prepared to buy that business? Are you prepared to operate it with your partners? Have you identified an outside party to operate that business that can operate that business the same or better than the current operator? And I think once your exposure gets more and more significant, you need to just be thoughtful of those worst case scenario decisions. Because it's great if you have conviction that you're going to get taken out in a year, 2 years, 3 years, but that may not happen. And then do your co-investors have the appetite to, let their money sit there for 10 years and hopefully come out at par?
I wanted to ask you, please.
I just want to add to the co-investor comment, because it's not just the round you're in, it's the next round and the round after that and the round after that. And I take a lot of time to meet VCs and spend a lot of time in Silicon Valley on Sand Hill Road, et cetera, meeting the Khoslas and the big names in VC, because I want them to know about our companies so that when our companies fit their model, they will get that signal that they need from those VCs. The family offices have a lot of power early on, but investing is an art form, and every deal has to have this combination of family office money plus signal. The VCs are the ones that are going to get you down the road to that IPO, and so they have value. But I love having the family office value in first, and then getting the VCs to come in. They tend to sit on the sidelines, they tend to be risk averse, but when they do come in, they have value. So I like to let them know who we're working with so that our companies get those big names on the roster when the time is right.
Within our family office, where we've taken active or very active positions in companies, sort of between us and some other families, or sometimes just us, really like to see that the necessary capital is raised and put the VC investment, with due respect to everyone here, to those here, to put that VC investment off as long as possible. And between us and others, we have some great relationships with a lot of mid-level VCs as opposed to the major names, and ones big enough that can take these companies and try to bring it to a view to bring up the best deal, and too many founders get stepped on by the VCs, and you really need to hold your own there. You need to have enough capital to make it through that. So to your point, Lisa and Thomas, that you're bringing up family offices where they are somewhat active in the company or really watching out for their investment, or ideally if there's a few there, can really help safeguard against these, and can also be that either capital supply or support supply over the years before some of these companies wind up in a lot more danger. Going to sort of, please.
I think what happens oftentimes, there is a knee-jerk to want to get one of the big name VC firms involved. And I think it's exactly right that there is value to the big name firms. The value happens later when you're closer to an exit. If you start involving big name firms at your Series A, more oftentimes than not, what you're going to wind up with is a 24-year-old who just got his MBA last week as your board member. You're going to get absolutely no attention from the real partners that are there. So they're going to just sit on that investment and hope you get to a Series C, and at that point, they become interested. Where you could have had a mid-tier VC really much more proactively involved in those early rounds and adding much more value in those early rounds.
Okay. We'd like to actually start off with Thomas and work way back now, just because you brought up a few things with hair on it, I think, that the way you talked about it. Let's talk about, on the negative side, things that can go wrong. Talk about some red flags, Thomas.
Timing. So, I think when someone looking for a family office or ultra high net worth individual to invest, that before they get to know them, they get to know their investment team, they get to know who they are, they get to know what their both investment passions are and philanthropic and personal passions are, and what their mission is as a family or an investor. They automatically go for the kill and say, hey, this is what I need, we need you to invest. And then there are subsequent calls within a week. There's an urgency for capital. It's a big red flag. If I really like an individual, I'll basically say slow down. Someone here mentioned, it may have been Howard, about getting hit up on LinkedIn. You know, I don't know. I don't pay much attention to my LinkedIn inbox because there are 30, 40, 50 solicitations a week, which breaks multiple regulatory rules. But more than that, I think I built my business advising family offices before I knew what a family office was. I think now that family offices, and there's a wide range of people's understanding of what they think a family office is in dollar amounts, and I'm glad you guys brought that up earlier, with people having a significant net worth, and then more than that, the services that are in-house to really identify someone as a family office. Deals with hair or red flags, I think the deals with hair, you get involved, the person may have great intentions. Once again, you need to find a way to exit or stimulate that business to take it out of the red hair zone. I think a lot of the red flags are just urgency for capital, unable to answer questions. I've had many funds that I've had a very strong interest in, and then it comes down to, hey, could you get me a DDQ? And 2 weeks later, I'm asking for a DDQ again. And if I didn't ask for that DDQ, I wouldn't have found out that 2 of the principals in the company had been convicted of certain crimes. So I think it's just really engaging outside parties, such as like a Mercer or a Castle Hall, or having partners that can do a deep dive on these individuals to make sure that they're real and the businesses that they're operating are real, and then references. So go out to their current investors, go out to their ex-employees, employers, so on and so forth, and make sure that the people that you're writing checks to are who they say they are. And I also, one more thing, I also think there's nothing wrong with anyone you're co-investing with, and this is part of our model in IDI, anyone that comes in as a new partner that we've identified, friend or not, we ask to see the last 3 subscription documents and the last 3 investments that they've made, and have them verify that they're actually an active investor. Because the last thing that we want is for when it's time to make a capital call to one of the portfolio companies that we have identified we're making an investment in, for that person to say, hey, I've fallen short, I can't make that investment, or not be who they say they are. So I think there's nothing wrong with saying, hey, let me see the last 3 investments you've made, and maybe I could reference it with the funder, the company, so on and so forth.
Steve, you mentioned earlier a presentation you saw where you were a little uncomfortable with the timing that the founder suggested. I can't tell you how many startups or how many founders have come to our team thinking they're on Shark Tank and doing that entire rehearsed, very elegant sort of presentation. We have no idea what the company does, but they were sort of introducing each other and playing songs and doing too many videos. Your advice for a founder on a presentation?
Wow. So I think that the probably the best advice I'd have is to know to make sure you know the most important message in the 8 minutes you might have on stage to go deal. I mean, one of the things that hopefully everybody that will actually see at tomorrow's expo, when they actually get up and deal, will be very well prepared. As a Keiretsu member, there's quite a bit of deal flow that comes through, and we actually see from time to time the time running out before they actually cover some of the most important points, like for example, what's the exit going to look like?
Good. Armando, I brought the question of red flags. Talk about some things that trouble you.
Well, picking companies is really easy. 3 easy steps. Number 1, you have to have awesome, good quality deal flow. Number 2, you have to be incredibly good at doing diligence. Number 3, You have to be fully prepared to mentor that company over the long term with really good quality mentoring. The problem is, getting good quality deal flow is really hard. Doing diligence is really hard. And doing high quality mentoring is equally hard. So the problem is assembling a team that's gonna cover all three of those steps somehow, so that you increase the likelihood that you'll be able to find a good quality company and take them all the way through to an exit.
Is it hard, or is it just expensive and time consuming?
It's hard. And the reason why it's hard is because it requires so much verticalized knowledge, right? Just take apart a diligence process alone. You have to have legal expertise, you have to have financial expertise, you have to have domain expertise. There's so much specialty that you need to be able to even just get through one of those steps.
Lisa, what is the role of an angel group with a family office that decides to invest early?
An angel group, like,
How should a family office work with angel groups?
well, I don't know how many are out there that are doing like what we might be doing. I think there's many flavors of investing, and everyone works a different way. We work with a back office that is AngelList. They have an operation that runs 25% of all early stage deals run through AngelList. So in terms of that operational side of it, we have ultimate efficiency because the platform's already existing. So our investors are all updated weekly, several times a week on things that are happening. I push a button and a message goes out to everyone saying this is what's coming up. How they work with us, typically, well, we have a fund and then we have syndicates that we run. So I let them know what deals are live. Like we've got 3 live deals right now, all very exciting in this cellular agriculture and space. We're backing the Axiom, the world's first commercial space station. And they want to know more because it's not just a deck that's online. And so we give them more access. We set up calls with the companies themselves so that our higher level investors get more access. Our lower level investors are going to get a deck online and they're going to get a deal memo. So we really have to be careful with our time and how we spend it. So it's really the investors that are putting more money into our deals are getting more of that personal attention, but the smaller investors, we're happy to offer the opportunity where they can invest at smaller amounts, but they still get access. What I've found is that we have family offices that find us, they join our network, and they dabble, and they put in $5,000, $10,000 into a deal, and then come to find out that they want to be a $1 million LP because they're learning, they're seeing how we operate. So they actually have a way to experience what we do without putting large dollars out first. So I guess we have this kind of wide range of access where you can be a small investor and just learn, or you can be a large investor and be invited to calls with founders, events, like we're having an event in New York with all of our 10 portfolio companies coming, and the audience is just our $250 million family offices and up.
So
Hold on just a second, guys. We got about 5 minutes left, so again, we're going to go ahead and collect all the gold sheets from everybody who's here. We'll have a couple interns and Juan going around to pick them up. And then we will have extra materials on the way out, so if you didn't get a chance to get a set of materials, we want to make sure everybody has that on the way out. Again, we'll be right back here tomorrow morning, 7:30 for our Angel Expo. We'll have our presentations and booth. So we'll have some follow-up remarks in about 5 minutes, but just a quick 5 minutes heads up. Please fill out your gold sheet, turn those in, and we'll collect the rest of them on the way out. So
Howard, can I add to?
Sure, and I just want to get in that and Chris, go ahead.
Okay, no, I just wanted the question being how to work, or how does the family office benefit of working with an angel group? So I happen to be a member of Crysti Forum, which is the group that put on this event, and one of the things that that I see in addition to the deal flow that gets on. I want to build on something that Armando said, which is that what I found in members of Crysti Forum are that you tend to have a lot of doctors in angel investment groups, so to the degree you want to vet out life sciences, it works out really well. My background is electrical engineering and software, and so it turns out for infotech deals, you can get a lot of that. It turns out there are lawyers and other service providers within the community. And so to the point that Armando made where, hey, it takes a lot of verticalized expertise, it is one of the things that I've actually found that Crysti Forum provides a very interesting piece, so that when companies, for example, come through at our monthly forum meetings, you'll hear questions asked of the entrepreneurs that you might not otherwise know to ask because some of that vertical expertise exists. So it's a good way to very passively be able to see what other folks ask about the deals in a very open forum. So I think it's a good way to start thinking about deals in a way that you hadn't thought of them before.
Adam, maybe you could talk about red flags, things that trouble you when you're looking at companies.
Sure.
Or what should we be looking out for?
And just to tack on, I completely agree with those add-ons. I think there's a general opportunity to learn with many of these angel groups, whether it's diligence in investment or learning more about the technical aspects of a term sheet. There's a lot of educational opportunities and network opportunities that go along with working with angel groups. So as far as red flags go, I think, especially in the early stage space, a very, probably the largest percentage of your risk is founder and team risk. There's a lot of great ideas and spaces that could be very, very, very profitable. It all comes down to your team. So for us, I think it's a red flag of either there isn't an extremely robust track record for a given team that we can feel comfortable hanging our hats on, or extremely strong referrals from others. So that's a big one. I'd say another is a wild range of raise targets. We're looking to raise 5 to 10 million. Well, that gives us an indication that there's not necessarily that much of a plan in place for a direction to take your business. And then I'd say the third thing that's just a balance. It's good to be confident and to have a vision on, say, your exit, but there's a line where it just frankly feels a little bullshitty when we're like, oh well, we're going to get acquired for $200 million by Salesforce in exactly 24 months. We've already talked to a junior level analyst who promised us, or the CEO. So yeah, those are some common ways.
And Crysti, back to the question, as a family office working with angel groups, good thing to do?
So we are just the angel investment arm among our family offices. I think it is very important for us to invest in the industries that we are most familiar with and align with the purposes. For example, to say if we are into one or two life science companies that must have the potential where we intend to acquire them, the parent company is intended to acquire them in the future. So we actually do this for a purpose, combined with our personal passion, both me and my business partner. We have individual visions and passion that we're pursuing, and we're trying to use our capital that we invest to promote that, or to help with.
Perfect. With that, ladies and gentlemen, thank you so much for a great panel. Thanks for putting up with me.